Exxon Mobil is one of the biggest companies in the world and it's a powerhouse in the oil and gas industry. The company is currently ranked in the Dow Jones and ranked third in the Fortune 500 and it has over 74,000 employees. Tons of people invest in Exxon, but Exxon has plenty of problems. It has major environmental criticism, has struggling revenue in the last couple of years, including with the pandemic, and has had a lowering stock price in easily the last 5 years. Hey everybody, welcome back to Trash or Treasure, where we're going to go through all 500 stocks in the S&P 500 and determine if they're simply trash or if they're treasure. And by doing that, we'll be able to build our own S&P 500 index for our own portfolio to determine what is valuable for us to invest in. By talking about Exxon's humble beginning, we'll look at the company qualitatively with their history and the SWOT method. Then we'll be analyzing the company and their financial statements quantitatively so we can kind of nail down an intrinsic value for their company. Hopefully this will be able to help us determine if Exxon is something that's worth to be invested in. So sit back, relax, enjoy the video, subscribe if you haven't already, and put a comment down the video of what I should do next time. So fun fact, Exxon Mobil is one of the biggest companies at my company's career fair. They actually weren't here because of the pandemic, but tons of people who go to that career fair at my university always want to work there. They definitely have a lot of experience and high achieving individual people there. They require like a crazy GPA of like 3.5 just to be able to interview. Anyways, Exxon Mobil's ancestry all begins with a Standard Oil company founded by John D. Rockefeller. When Rockefeller's company was torn apart, it was turned into many different oil companies that had the Standard Oil Company of blank. The two that we're interested in today is the Standard Oil Company in New Jersey and the Standard Oil Company of New York. These two companies were born a long time ago, but these companies eventually became Exxon and Mobil respectively. So Exxon for New Jersey, Mobil for New York. Exxon and Mobil eventually signed a massive merger deal in 1998 that was worth $73.7 billion. And at the time, it was the largest corporate merger ever. In 2010, Exxon bought XTO Energy, which is an innovative company that is focused on discovery and production of alternative energy. An example of this would be something like algae. In 2016, the CEO of ExxonMobil, Rex Tillerson, was nominated to be the Secretary of State, and Darren Woods of Texas A&M, became the CEO. As you can see, ExxonMobil's name may have been relatively new, but Exxon and Mobil have been our companies for a very long time and have very old history. XTO is a very interesting acquisition for their alternative energy potential. Now that we know a little bit more about the history with Exxon, we're able to now talk about some of their qualitative aspects. So quickly, if you do not know what the SWOT method is, it is a simple method that quickly analyzes a business. It stands for strengths, weaknesses, opportunities, and threats. So we get a good understanding of what the company is good at and what the company is not so good at. First, let's start with ExxonMobil's strengths. Start with S, SWOT. Exxon has massive brand value. Everyone knows what ExxonMobil is and that they have one of the best gasolines in the world. Maybe not the best, but it's definitely one of the top two. Definitely better than going to be some random Texaco or even something as popular as Phillips 66. Another good brand is Mobil 1. That branding is everywhere in the racing world and motor world for motor oil for your cars, but it's also branded all over Formula 1 cars such as Red Bulls. Exxon branding to the average person is definitely going to be on a good standing that they know that they can get great gasoline and lubricants for their own vehicles. In addition to brand value, Exxon also has a strong market position, dominating many of their markets and with all their products from, again, the motor oil lubricants to that gasoline to all other products that they make. ExxonMobil's market position could not have been created without their extensive operations being fully integrated company, which means that ExxonMobil operates both the upstream, midstream, and downstream of the business. So upstream, quickly, what that means is taking the oil out of the ground. Midstream is in transporting that oil throughout different markets with the pipelines. The downstream side of the business is the refining and actually turning this into products that we use, such as lubricants, oil, jet fuel, diesel. ExxonMobil spends a lot of time with R&D. They focus a lot on trying to build better products and better equipment for their refineries and for their drills, while also finding alternative energy that's more profitable for them. Some of this energy is renewable energy, such as algae. Another example of energy they've been focusing a lot of time is natural gas, which is one of the cleanest forms of energy. From investment into XTO and increased reinvestment into research and development, Exxon has become much more of an innovative company than in their past. And to put just from the strengths of the perspective of other companies, there's many other companies that spend no money on R&D and just buy off different products from other companies. Exxon Mobil does a little bit of their R&D in-house and doesn't have to rely so much on suppliers. As you can see, Exxon Mobil has a strong list of strengths, but they do have one major weakness we really need to talk about, and this can be a really tricky one to solve. Exxon Mobil has a ton of negative publicity. Even though people know they have the best products, people don't typically like Exxon. Some of it is justified, some of it is not so justified, but it's definitely there, and there's definitely no coal for companies like Apple or Tesla. Exxon is often criticized for not caring about the environment and not trying to find a better way to decrease their carbon footprint and reduce the amount of carbon emissions. Personally, and I'll be showing a lot of my opinion here, I think the problem is simple to solve. A great way to get people invested into your company or to start talking about your company is through just YouTube ads or sponsoring YouTube videos. Some of them are annoying, some of them are quite interesting, but if Exxon Mobil were to spend less of their money trying to tell you how great they are and how much they impact your life, and talk about what the cool things they're doing and how they're impacting the community through YouTube AdSense or any other type of marketing, that could be really, really huge. My example is, imagine when Mr. Beast did his team trees, Exxon Mobil provided some money and supported that effort. Exxon should reimagine and re-engineer their entire marketing campaigns, should focus more on the younger generation and communities instead of just throwing some ads on TV. Exxon has some strengths, they have a big weakness, but what opportunities can we really talk about, and how are they really threatened? Exxon Mobil has a lot of interesting opportunities actually. Both are really related to exploring new energy. Renewable energy has great potential for investment and has great investment opportunities as governments are highly incentivized to encourage them and subsidize them. Also, natural gas is another great option for Exxon Mobil. It is still a fuel that has to be burned, but it's one of the cleanest form of hydrocarbons, and being able to take high advantage of this will allow them to decrease their carbon emissions even more. In conclusion, Exxon has plenty of great opportunities to explore newer, cleaner energy options. There are a few major threats the oil giants should be worried about though. One of these are relatively obvious, as every company has to deal with these threats. Exxon Mobil is not the only oil giant. Unintegrated companies might be able to do their niche a little bit better than Exxon does. Think of someone like Apache or someone like Marathon. And imagine if they can do something a little bit better than Exxon, meaning that even though they do everything, they can't really do anything that well. But also you have the risk of larger companies that might just do everything better. Think of Shell or Chevron. They can just challenge Exxon head on, find better oil wells, have better piping networks, and just be able to produce their gasoline at a cheaper price that Exxon can't compete with. So that is definitely a threat they always have to worry about. Also, all oil and gas companies have to deal with the looming threat of environmental regulation. Currently, this is not as a major threat. A sudden change of heart from government could really change how these companies are able to operate. For example, think about California. They have a huge incentive for cleaner fuels, and it's become a lot more economically viable. So a lot more companies are spending a lot more time to make cleaner fuel for California. And if companies such as Exxon are able to capitalize on those opportunities, that could really hurt their business. Now let's move on to the quantitative analysis. All right, everyone, now that we're on the computer, we can now look at Seeking Alpha and MarketWatch and then look at all the possible information we need in terms of financials. So like we said, we're gonna look at the dividends, revenue, net income, and free cash flow. And let's start with Seeking Alpha and look at those dividends. So here I am on Seeking Alpha. You got the stock price, you have market cap, you have the dividend yield, but we're gonna go right over here to dividends. So yeah, Exxon's stock price is 8.9% dividend yield. Their annual payout is $3.48, which seems great. You're getting about a 9% return on your money for every stock of Exxon you own. But there is some risk with that I do want to talk about, some of the dividend history. So you also see here the dividend growth. It's been increasing the last 19 years, which is also a really good sign to see. It's really good to see a stock constantly increasing in price. You don't want to see this like crazy ups and downs with their dividend payout. And we can see that in their dividend growth here. So yeah, year over year, the dividend has been increasing again and again and again. And this is typical with large companies such as Exxon, and you'll see this a lot with the oil and gas. They love to pay out dividends because they find that that's a better way to spend their money and just give it back to the shareholders instead of putting it back into their own business. All right, so the next thing we want to look at is dividend safety. So we're getting that 8.9% dividend yield, but how safe is it? How likely are they going to continue paying that? So cash dividend payout ratio is
a decent ratio to determine how much of their cash flow are they paying out in dividends. And then this is a pretty yikes number. So negative 903%. If this was positive 900%, that means they would be paying out 9 times as much as they made. But the negative means that they just didn't make any money that year and they still paid a dividend. So that's super scary. You don't want to see that at all. This is a big no-no. We definitely don't want to see that, and that should be very, very scary. All right, now let's move on to Market Watch. First, let's look at revenues and sales. So revenue and sales is a great way to look at how much of a product a company sells. And if that number is increasing year over year, that you can typically correlate that with them selling more and more product. So if I sold 1 pair of Gucci slides for $500, my sales and revenue would be $500. If I sold 2 pairs next year, it would be $1,000. But you always have to subtract that by the cost of goods. So that's the next tab under here. And I typically like to look at this for an oil company also, as their cost of goods sold is very expensive. And you can see that here is very, very expensive, which then does really affect their gross income. Important thing to look at here is sales and revenue is increasing year over year. The gross income is increasing year over year. But we're more important want to look at net income. So after all these expenses, after paying all their employees and paying all their debt, what do they have left over? This is their net income. This is increasing year over year. If you look at it on a trend curve, it does have these dips, make that correlation a little less obvious. It looks a little flat when you look at it with the dips, but it is increasing. Technically, I'll show you it on another Excel sheet. So we got increasing revenue, we got increasing net income. That's all pretty good. We like to see that stuff. Big numbers. Maybe there's an opportunity to keep decreasing the cost of goods sold, get that number down even more efficient fracking, more efficient oil drilling. All right, so now let's look on the free cash flow. So this is the end of all their expenses. Again, an increasing trend in the correlation. This number is a little weird. It goes back to about a couple years, but we do have an increase in correlation. So that is also really great to see, that increase in cash flow, but that number is a little bit more worrisome. Now we have that free cash flow. We can now start to look at an intrinsic value. We have really good revenue. We have really good net income. We have pretty good cash flow. We also have a terrible dividend. All right, now we're here on my program on RStudio. RStudio is just a great little resource to do some programming on the side with financial statements. If you haven't used RStudio and you do know how to program, I definitely recommend it. Maybe one day I'd talk about it a little bit more in detail, but it's definitely going to be complex. But I made this whole thing, a bunch of lines of code. We'll go here and type Exxon's ticker, and we'll run the program. So here we have the intrinsic value. So is this a company I'd invest in? No. Obviously, it's just no right there. Stock price today, this is off of Market Watch. The intrinsic value, shares outstanding, and the intrinsic value in terms of its market cap. So intrinsic value of the company is $32.83, which is almost market price, which of $39. So Exxon Mobil is starting to become fair value, but it's still not quite there yet.
Hey, so I hope you guys got a lot of good insight in that video. We talked about a lot of things. We talked about the company qualitatively, we talked about the company's history, we talked about the company's cash flow and overall financial statements. And hopefully you guys got a lot of really good information about that. You probably got a lot of my own opinion in there, and I like to just be as transparent as possible about what my own opinions are. And overall, Exxon is an interesting opportunity to buy. Right now, it's currently in a fair value territory. I would recommend you guys keep looking at different types of stocks and keep looking at their competition and just reading more about Exxon, and just to absorb as much information as possible before you invest in them. But hopefully this gets you guys a really good starting point and you guys can really decide what to do with Exxon in the future. I hope you guys enjoyed the video. Make sure to like and subscribe if you haven't already. Comment down below what company you want to do next. I think next company I'll be doing Marathon Petroleum. This is my first video and I've really had a lot of fun doing this so far, and hopefully this becomes like a really successful thing and I help a lot of people out in the future. Alright guys, see you guys later. Bye bye.